Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. This podcast was sponsored by Allspring Global Investments. As such, the sponsor may suggest topics for discussion, but the final control remains with the Investment Innovation Institute. Welcome to the i3 podcast. I'm here today with Jamie Newton, who is the Head of Global Fixed Income Research and Deputy Head of Sustainability for Allspring Global Investments. Jamie, welcome to the podcast.
Thank you very much for having me, Walter.
No worries. So can you tell me a little bit about your background? How did you get involved in investing? I think I had a little look at your bio and I believe you originally started as an auditor, which is sort of an interesting background, but I think it would be quite useful in credit analysis.
Yeah, we even go a bit further back than there because it gets even more perplexing, I guess. Starting at university, I thought I was going to be a doctor. But after the first semester, we walked into second semester bio and they said, we're looking under microscopes for the next 16 weeks. And I said, I'm not looking under microscopes for the next 16 weeks. So I went to my advisor and had a conversation, and I'd always been good with numbers. I enjoyed numbers, enjoyed understanding why things worked, what drove different opportunity sets. And so I found my way into economics and then accounting because of the fundamental nature of it. And accounting led me to audit, where I spent 4 years at Deloitte and Touche, which was a terrific background for investing. You develop, you're auditing the financial statements, you're helping develop the notes to the financial statements, you're helping articulate what the management team is trying to think about, and you're having conversations with management and getting comfortable with those relationships. And so it was a terrific place to launch a career in investing. However, I like more dynamism in my life. And so thinking about investing and having the opportunities and complexities and movements of markets was what interests me. So I went back and got my master's degree at the University of Michigan and found my way into the investment world. And I've never looked back. It's been a terrific ride.
Excellent. Yeah, I suppose microscopes don't talk back much in a
No,
conversation.
quite quiet.
So I also saw that you worked for a number of insurance companies, and of course, from a fixed income perspective, that's quite interesting because they're very heavy investors in fixed income, but they also tend to be relatively conservative. Has that sort of been adopted in your view on fixed income over the years?
Yeah, and I think it fit me personally as well. When I was getting into investing, it was during the go-go days of the internet in the late 90s, where momentum was the primary driver, especially in the equity market. And I found myself being much more fundamentally based. And I think that comes back to being an auditor and really wanting to understand the way things operated. So as I came out of university with my master's, Northwestern Mutual, had an opportunity within their private placement group to really do core fundamental research. And that's what I jumped into because it really fit me. So I spent 3 years in the private placement group there, learning and adapting and understanding the goings on of an insurance company and their investing. And so I understand that very well, but I liked, again, a little bit more activity. And so I moved my way into the public markets at the same spot and learned a little bit more about how they thought about it in the public marketplace. And then had an opportunity at an up and coming entity at that point in time. And so moved my way to a traditional asset manager.
So if we fast forward to today, you're looking at fixed income research. So I saw a couple of papers from Allsprings, and it seems to say that 2025 is the year to add duration to the portfolio. I think it was called riding the curve. Can you tell me a little bit about the drivers behind sort of this idea and have the first couple of months of 2025 panned out that way?
Yeah, so the basis is that, broadly throughout the world, there's a lot of money sitting in short assets, and we think that there's an opportunity to expand a little bit further out the curve because while in the US we may be in a holding pattern here for a while with Fed funds, much of the rest of the world is in a declining rate environment. And so we're thinking that it's probably better to move a little bit out the curve. We're not saying go to the far end of the curve, but we're saying look at the 3 to 7 year part of the curve for your duration because you're getting paid and you're getting income, and that income has value, and it won't be with us forever, especially if rates continue to fall, the front end falls, and you can't then replace it because the rest of the curve probably goes with it, especially on the front end. So we think that getting into a little bit further out the curve, again, 3 to 7 years, kind of is that sweet spot, it is opportunistic right now. Additionally, we like spread product, and you could argue that corporates are trading tight. Yes, they are, but we also think that picking up that additional yield has value. And so we think that that's an opportunity. Same with structured products or securitized products. Um, Whether it's the RMBS space or the CMBS space or even the ABS space, we think that there's opportunity to take spread to expand that yield opportunity, and you're supposed to take advantage of that at this point in time.
So what are sort of the risks to this scenario? And I think particularly about, there's a lot of things happening in the US with Trump coming in, there's trade wars, there's tariffs being put in place. Is this making this scenario less likely going forward?
As I said, I think the U.S. is a bit of a pause. We need to see what happens and what policies and actually come out of the Trump administration. Tariffs are being thrown about and bantied about. What actually happens, we need to see, right? Is it a negotiating ploy, or is it in fact going to occur? And if it occurs, who does it really hurt? And that'll be something that happens at the company level and potentially at the sector level, and then potentially at some of the sovereign levels. Nonetheless, if you think about traditional U.S. assets, it's especially in fixed income, it's U.S. based, and they're probably going to do just fine. One, they're in very good fundamental shape. Two, the economy still remains very vibrant. It's slowing, but call it 2% plus or minus 0.5% for 2025. Still sound growth. The employment structure is very well. 4.2, 4.3% unemployment is in the low end of traditional ranges. CPI or inflation remains in a pretty good spot. So all in, we're okay. As you noted or asked the question, what's the risk factor here? The risk factor is that something over and above expectations occurs and really starts to drive inflation higher. We don't see that right now, but we're not saying it's an absolute not going to happen. But at the same time, how much higher can inflation go? How quickly? Those are the questions that we'll have to ask ourselves. But that's also why we like that kind of 3 to 7 year part of the curve, because you're short enough that you won't take a lot of duration risk and really hit, the price value of your investment, but you can have that income, which is supportive of, a traditional fixed income investor's traditional focus.
Yeah, you just asked that question, how high can inflation go? And it sort of always reminds me that having a conversation with my parents, they always remind me that they used to have a mortgage at 19%. And don't you forget that. And I'm like, yeah, that's a long time ago. Do you think we're gonna ever see those days again?
You can never say never. I just think it's highly unlikely. Could inflation go higher? Yes, but let's even go back a couple of years when we did have, more of an inflation snap and all the dynamics that went into it. The world's in a different position, even though there are parts of it right now, the Trump administration be more isolationistic, but nonetheless, there is still a flow of goods globally. There is still, active monetary policy. The central banks globally have reacted as they've needed to stem inflation, and I believe they will again. So I don't see currently some possibility of us going to those levels. But we have to be, eyes open, right? Because the world changes every single day, especially with some of the governments in place around the world. We just have to be thoughtful about those types of risks. But you also have to put money to work. And in our scenarios now, we're very comfortable putting money to work.
For sure. And I think it's interesting as well because only a little while ago we were talking about a recession that was inevitable, but it never came. And I think at the start of the year, it even seems that there were less recession concerns as global growth seemed to be stabilizing. Is a recession definitely off the cards?
As I said, you never say never, but we think it's a lower probability again this year. I think the risk has increased a little bit, to be honest, because of some of the rhetoric that's been going on. Nonetheless, if we think about, where the US and the globe stands, it's unlikely. We saw a couple countries in the UK, playing with a potential, recession last year, technical recession, but I don't see that more broadly, and I don't see that in, the US and some of the other major economies. We continue to see stimulus out of China, which continues, supportive growth around Southeast Asia. We talked about the US being in a very sound spot. Could things go off the rails? Yes, but it would take really, really aggressive policy action, and I just don't see it now, at least not in 2025.
Yeah, yeah. It does seem that the economy and global developments, especially geopolitical developments, seem to be just accelerating at a greater pace. And of course, most of the sort of predictions and circumstances that we base our views on are on indicators that are often lagging. Do you think that this becomes more of a problem that the economy is moving much more quickly than we can catch up with leading indicators?
Um, I think it's a very interesting question, but if we think about the indicators that are more active, so think a monthly indicator like the PMI indicators globally, we track those. We're looking at the manufacturing, the non-manufacturing, the composite, what the leading indicator surveys are coming out globally to be thoughtful of that because they're very timely, right? We get more information daily. We got some of the numbers that came out of France and Germany today. One showed, slightly improving, and Germany's still having its own, modest issues.
Yeah.
But we do have, a lot of commentary all the time. The Fed, the ECB, the BOJ are out with commentary like every single week. So you can get a pretty good feel as to what's going on, even though we may not have a GDP number that's final for several months, if not quarters, after the period's done. But there are enough indicators and surveys that are going on that you can put your arms around things in a pretty reasonable way.
Yeah. So can you tell me a little bit what you see as some of the more interesting parts of the fixed income universe? We spoke a little bit about duration and where you see opportunities there. But in terms of sectors, is there anything that stands out?
Yeah, I mean, we still, we do like structured product or securitized product, namely in the US, MBS, but we like ABS in general, especially in US dollar assets. There's lots of opportunity. There are lots of different subsectors that are coming to market, whether it's the fiber space, the data center space, that there's opportunity to be had. If we think about more traditional corporate credit, there's still opportunity. We talked about spreads being on the tighter end of the historical ranges, but if you get into the details, there's still opportunity within banking, within certain sectors of the REIT marketplace. There's still opportunity in some of the TMT names. That idiosyncratic opportunity still exists. While the whole may seem tight, there continues to be opportunities in the marketplace. And that's what I think our team does very well. And that's why you have asset managers with broad research teams to be able to support those types of views and ideas and be opportunistic in the marketplace.
You mentioned, I think, fiber assets and data centers. What's sort of the opportunity there? I mean, we usually hear it from more a infrastructure property type of opportunity. What's sort of the fixed income side to that?
Yeah, so the fixed income side is some of these buildings are being built up with lease rates that are already guaranteed, been contracted, and so they're guaranteed. And so in order to build the buildings, many times they're financing that with a secured asset where they're securing those cash flows. And so they come to the market in the fixed income space and offer that as an opportunity. And so you can gather some nice yields. You have to know the underlying taker. You have to make sure you're comfortable with what's going on and they have enough electricity to provide the service. But it's an interesting and growing dynamic right now with all the talk around data centers and AI and technology generation.
Are you worried that that area is getting a bit frothy with all the investments going into this area? And I sort of mentioned that because I've seen in Australia, particularly in Sydney, a land deals where land is being grabbed up for data centers, where you think, wow, that's a little bit above market price.
We're being thoughtful about that for sure. We get into each data center on its own to understand the dynamics, the necessary resources that are available to it, whether it's electricity or the natural resources like water and other things that are necessary. So we do it, it's a site-by-site situation. We have to be thoughtful about it. Yes, it feels like it's, gotten more aggressive, but these are just commitments now. And as they get built out, then we'll see how far it goes. But with the likes of a Microsoft and an Apple and Meta and every Google and everybody else that's invested, there's probably some more runway to go yet.
Yeah, yeah. You mentioned those names that are a part of sort of the Magnificent Seven, with it's caused a lot of trouble in the US equity market for managers on the equity side. Does that sort of come through on the fixed income side as well? Is there sort of a flow-on effect for this concentration of the market?
Not to the same degree that the equity side has. The equity side has, an unlimited upside if you want to go to that direction. We get capped out at certain levels. There's just a point in time where you're not getting paid for you're not getting the yield you want or the spread to premium that you want for that. Um, and as it gets tighter, then people just find other opportunity sets.
Fair enough. I think one area you have singled out in the past is municipal bonds. What is sort of the opportunity there?
So specifically in the U.S., municipal bonds offer an opportunity for investors to invest, with a tax advantage. And so that tax advantage for high quality credits, which are U.S. municipals, is very, very attractive. Now, municipals also have taxable debt as well, which is what many foreign investors uh, get involved with too. And if you think about what that really means, it means you're getting pretty much a like for like spread many times that you can with a corporate credit, but with sometimes better credit quality, right? A municipality or a city, a town is less likely to go bankrupt than a company in most cases. And so if you do your homework and you do your research, you can invest in a very high quality asset at comparable to corporate spreads.
Yeah, yeah, fair enough. What is sort of on your research agenda? Do you have any specific projects coming up?
We continue to do, our bottoms-up idiosyncratic research. That's the primary source of our alpha generation for the portfolios that we support. That's really the lead opportunity. We're always trying to be thoughtful about what the next thing is. We mentioned AI more in passing,
Yeah.
but we're thinking about AI and how it integrates with research efficiencies that can be provided, but it's not going to replace the analyst because of the qualitative attributes in thinking about strategy and thinking about the hows and whats and whys. Bonds may trade different directions. We're always trying to think about the next thing. It's gotten us, into those idios or those esoteric asset-backed areas of data and fiber. Um, we're always being thoughtful of the next thing, but fixed income doesn't change all that drastically that quickly.
No, I think one thing that has changed sort of over the years is that, we've seen more fixed income instruments moving away from sort of the over-the-counter market to more automatic systems, more automatic trading. Do you ever see sort of an opportunity for AI to come into that and potentially sift through this data?
It may be beneficial to some degree. I mean, we've thought about using it as well, and we're exploring that actually. But as far as the trading goes, you still need a fundamental overlay, and you still need to have that qualitative assessment to find the value. Where it can be potentially advantageous is in the very high quality credits to try and take advantage of mismarkings or inefficiencies in the market. But those can get taken out pretty quickly. And so, um, as far as the trading goes, probably not. However, it could be used in portfolio trading potentially. But when you're really building an active portfolio, I don't see it taking, you know,
Yeah.
a lot of space at this point in time. Could it
Yeah.
change? Yes, the world changes every single day, and we'll continue to watch and be mindful and be thoughtful of it, but not yet.
Yeah. One interesting development, which is not so much related to AI, but more to technological innovation and sort of the blockchain area, where we're talking about smart contracts and then self-executing bonds. Is that something that you keep an eye on?
Yeah, we've been exploring blockchain to see where there might be an opportunity set to utilize it. We want to make sure that we're not missing something and that we're understanding it, but we haven't delved that deeply into it as far as putting it into an operational perspective. But certainly we are keeping an eye on it because it does have some interesting attributes and some interesting use cases. So we're being thoughtful about if there is some uptake by asset owners and other investors, but we haven't seen enough development to start engaging directly yet.
Yeah, yeah. Coming back to a little bit more of the traditional side of fixed
Yeah.
income, we've seen a lot of interest in private credit in recent years. What is your take on that? Is that starting to become a little bit elevated?
I think it has become elevated. I do believe that there is a place for private credit and private equity or sort of private assets in general. However, I think you have to be thoughtful about it, just because it's been the place to be over the last several years, right? And actually, if you go look at the data, there's a lot of dry powder on the sidelines at a lot of those entities. The problem with that is that tends to lead to more aggressive purchasing, which drives down yields and IRRs that are expected, or gets you into lesser credit quality credits, which leads to defaults over time, which adjusts IRRs. So that's something we're being mindful of, especially when you get the likes of a JP Morgan and some of their peers that are saying, we're going to put aside 50 billion for direct lending, or we're going to go do X. That starts to change the game for some of these investors. And so is there a place for it? Yes, I think it fits as part of a broader investment portfolio set. But I think you just have to be thoughtful about what that allocation looks like and why, and that it's likely changing. And the last 10 years is probably not going to look the next 10 years won't look the same as the last 10.
Yeah, yeah. I think one of the things to keep an eye out for is often mentioned that it hasn't really gone through a proper cycle where we have had high levels of defaults, and even though there's to a limited extent you can model some of that on previous historic data, we haven't really seen that. Is that a concern for you?
Yeah, it's absolutely a concern. And actually, if you start looking at loan default rates in the private marketplace compared to, the default rates in the public marketplace, they're much, much greater in the private marketplace right now. And the transparency into your valuation is much more opaque in the private market space. We're starting to see stories where things are marked at 85 and they file for bankruptcy. Well, that's one story, and yes, it's one, and so you can't paint everybody like that, but that's something that investors need to be thoughtful of. But if you think about the real heyday right now that the private markets have gone through, especially private credit, look at the rate dynamic in which they lived in. Really low interest rates, which puts really low interest expense on these companies. But as rates have gone up, you've started to see adjustments. And we didn't have that effect go on during COVID because of all the stimulus that happened. All these companies got a lot of, free funding, more or less. And so we're able to walk their way through it. Now we're into higher rates and we don't have that physical stimulus. So you're starting to see those default rates rise. And it's something that we're aware of. And you have to be thoughtful about that and the implications of such.
Yeah, for sure. Now, I introduced you, and there's a second part to your title,
Mhm.
Deputy Head of Sustainability. Sustainability, of course, we have seen a lot more activity with that on the equity side. How does that translate to the fixed income side? I mean, is that all about credit, or can you apply it as well to sovereign bonds?
Yeah, I think you can apply it to sovereign bonds and to corporate credit. In the corporate credit scheme of things, we're trying to think about um, climate risk that could manifest and what companies are trying to do to make themselves sustainable. We're trying to think about, other factors which are traditional fundamental factors, which just get encapsulated into ESG, but cybersecurity risk is a business risk. It's part of the game that we play every single day, especially in the banking space or the insurance space. We think about, you know, pipeline maintenance in the energy sector. If you don't take care of your pipelines and there's spillage, there's risk to not just your business, but to litigation and retribution. And so there's other things that you have to be thoughtful of. And so sustainability is certainly something we have to think about and incorporate in our thought processes because there's just inherent risk with it. As far as the sovereign space goes, yes, we have to be thoughtful of that too, because as we've seen, an increase in the number of extreme weather events globally over the last 2 decades, that has implications for certain countries, especially low-lying countries and or island countries, and you have to be thoughtful of that. Doesn't mean you're supposed to avoid it. You just have to be thoughtful about what you're getting paid for that risk that you're taking.
Yeah, yeah, for sure. And is green bond something that you look at? And if you look at it, do you look at it from a sustainability point of view, or are you looking at it from your credit research point of view?
We look at it from a credit research point of view. Green bonds are an interesting structure. There are some advantages and there are some technical advantages because there are funds out there that want just green bonds. However, when we think about it, and we think about it from a fundamental point of view, they're pari passu with other senior unsecured bonds. So we need to get paid similarly. We're not going to pay up for green bonds because our risk isn't different in it. That's just the way we fundamentally focus.
Do you think the area of green bonds, the market, and also more broadly sustainability, is that a more challenged area now that we have a president in the US that is not particularly fond of sustainable approaches?
Um, we've definitely seen, DE and I under pressure. We had another announcement, from a company today. Um, every business and management team is going to make their own decision on that, and that's what we'll have to think about. We've typically thought about it from the point of view of risk, and that's how we've tried to assess it and consider it. It's the risk and materiality of in the impact on a business or a sovereign. And that's how we've thought about it. And I don't think we're going to change that approach at this point in time because we go back to, again, that fundamental risk. But certainly it's changing. The Trump administration is seeing or causing that to happen. And there are other constituents around the world which have a similar bent. We're seeing changes everywhere. Um, Not necessarily to the same degree that the Trump administration is kind of pushing right now, but certainly now the Germans are thinking about, doing nukes again, which you go back 7 to 10 years, that was off the table. And now the world's changing and there's just an evolution.
Yeah, there's some interesting developments going on. On the more positive note, you're coming out to Australia, and of course you're coming out to meet with some of your clients. But do you have any views on the Australian fixed income market? I think it's for me, with my background coming from the Netherlands, I was surprised that pretty much every bond, every is pretty short dated. Like mortgages are floating rate, not like your 30-year mortgages that you get in the Netherlands. Do you have any views on the Australian market?
We are buyers of Australian paper that issue in US dollars predominantly, some in the euros. We like a lot of the businesses that are there, whether it's some of the banks, some of the energy companies, and so forth. Um, it's a different market in the in the AUD market, as you just described, and spreads are tighter typically, and so we tend to stay in our home market more often. But we do, and take advantage of the opportunity sets when Australian companies come and issue in US dollars and euros.
Yeah, yeah, for sure. Well, I hope you all have a good time when you come out to Australia, and thank you very much for this interview.
Thank you very much. I look forward to my travels, and thank you so much for the time today.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.